Welcome to Finance Flashcards. Are you someone who wants to invest in a stock market but you are unsure how to analyze a stock before making a decision? Well, you are in the right place. In today's video, I am going to break down the 5 essential steps of fundamental analysis, the process used by a smart investor to evaluate a company's financial health and future growth potential. By the end of this video, you will know how to understand a company business, analyze financial statements, evaluate key financial ratios, check for liquidity and solvency, and compare with competitor and industry benchmark. Alongside, we will also look at technical analysis. So, if you want to make informed investment decisions and avoid costly mistake, stick around till the end. So let's start with step 1, which is understanding the business and industry. Before investing, you need to know what company does and how it fits into broader industry. Now there are multiple ways to do business analysis, but these are the key questions that you should ask before investing in a company. The very first one is, what does company do? What is the business model of company? By this mean, you will be asking what are their products, what are their services, and how the company generate its revenue. The second thing is getting the knowledge of competitive advantage. If the company has any standout features like strong brand name, strong patents, or what is the market share of the company. A company like Apple has a very good brand name and on from its ecosystem. Most of the Apple's revenue come from ecosystem. So that's how we're gonna analyze product and look for strong brand name. The third thing is industry trend. Is the sector growing or declining? Before making any investment decision, we will look at, if we are analyzing automobile industry, we will see what is the future prospect of automobile company. We have to make a calculative guess whether the industry will grow in the future or it will decline in the future. The next thing is your management quality. Does the company have experienced leadership and a good quality track record of the higher leaders? So based on all these four questions, we're going to understand what is their business model and how the company stand out in a particular industry. Next up is analyzing the financial statement. Now, financial statements are the backbone of stock analysis. They reveal company key financial performances. Now, there are three main statements that we look for. The first one is income statement, the second one is balance sheet, and the third one is our cash flow. Within income statement, we see what is the revenue of the company, what is the expenses of the company, and what is the net profit of the company. And within that, we look for consistent revenue growth and healthy profit margin. So let's say a company is growing at a pace of 10% each year, so we can consider it as a good benchmark and we will see a good potential in the following company. The next one is balance sheet, which display assets, liabilities, and shareholders equity. Now it tells us about what is the financial health of the company, and in particularly balance sheet, what we look for is, we look for what is the debt of the company, what is the debt to equity ratio of the company, and what is current ratio of the company, which is current asset upon current liability. We will look for these two ratios in later part of the video. And our third statement is cash flow statement, which reveals the track, which keep the track of cash inflows and outflows within the company. Positive cash flow indicate a positive cash flow indicate a good strong financial position, while on the other hand negative cash flow indicate that the company is not doing good on a cash flow basis, which means it is not generating enough positive cash flow. Now let's move on to our third step, which is evaluating key financial ratios. So on a broader scale, we look for two of the major key financial ratio, which is profitability ratio and valuation ratio. Profitability ratio tells us about how much profit is generated, and there are two key ratios that we look for in profitability ratio. The very first one is our return on equity, which is ROE, which is nothing but net income divided by shareholder equity, which tells us that if the company has $100 of equity, how much net income the company is generating. Suppose the company generated a $15 of net income, so the ROE of the company would be 15 upon 100, which is 50%. Now the key benchmark is higher the ROE, the better the performance of the company. And the second thing is net profit margin, which is what is the net profit of the company from its total revenue, which is also known as, which can be also be seen as how well company is managing expenses. Now let's move on to second ratio, which is valuation ratio. Valuation ratio broadly tells us about pricing of the company. It tells us about how much we are paying for this particular company in comparison to average industry price or some other stocks. Now valuation ratio cannot be seen in isolation because it is a ratio and it needs to be compared with something other, which could be industry average or some other share in the same industry. The two key ratios are price to earning, which is nothing but price per share, which is current market price divided by earning per share. And the second one is our price to book ratio, which is market price, which is current market price divided by book value per share. Now let's understand what is EPS and what is book value per share. EPS is earning per share. Now earning is our net income divided by total outstanding share. Let's say company generated a net income of $15 and the company has outstanding share of total outstanding share is 15. So what will be the EPS, which will be nothing but 15 upon 50, which is 1. And if the current market price is, let's say, $10, so our PE ratio would be 10 upon 1, which is 10. Now what does this mean? If we break down the PE ratio, we will understand that we are willing to pay $10 for each dollar for $1 of earning. So if company is getting a profit of $1, we are ready to pay $10 for that $1 of earning. This is the real meaning of price to earning ratio. Similarly, price to book ratio is same, but instead of using equity value, we use book value per share, which is nothing but which is the total asset minus total liabilities. So these were two key valuation ratio that we need to look for before investing, and a benchmark is that the lower these ratios, better it is. Next is our step 4, which is checking for liquidity and solvency. Liquidity means meeting short-term obligations and solvency means meeting long-term obligations. Obligations are nothing but kind of debt that company owns, or it is obligated to pay its debt owner or equity owner, or kind of loan that the company has taken. Within liquidity we have two important ratios, which is current ratio and quick ratio. And in solvency we also have two, which is debt to equity ratio and interest coverage ratio. In the balance sheet section we see that there was current ratio. Why? Because both the component of current ratio comes from balance sheet, which is asset and liabilities. Now current ratio formula is current asset divided by current liability, and the ideal ballpark range is having 1.5 to 2, which means if the company has $100 of liabilities and $200 of assets, which means the current ratio is 200 upon 100, which is 2, which which could be seen as a good number or a fairly decent number. And the second one is our quick ratio. Now quick ratio remove the inventory part from the numerator, because sometimes inventory might not get sold in a year, so they might become illiquid. So for the sake of it we remove it and we try to calculate the quick ratio. And again the ballpark range is, if our quick ratio is above 1, then we can say that okay, the ratio is fairly decent and the company will pass our checklist. Now the second one is our solvency ratio, which look for long term obligations. And in long term obligation we have debt to equity ratios, which tells us about how much debt the company has by the factor of what is the shareholder equity. And the ideal ballpark range is below 1, or it is generally said that the lower the debt to equity ratio is, the better. Why? Because in debt company need to pay interest. So interest will go from profit, and if the majority of profit will go on paying the interest, then there will nothing left for the company to reinvest and grow the business. So it is ideally said that the less debt the company has, the better it is. And our second one is our interest coverage ratio. How much interest the company can cover from its EBIT. EBIT is our earning before interest and tax. Why interest and tax? Because interest we are paying, and because this debt is tax deductible, that is why we are taking EBIT, not net income. And if it is above 3, a ballpark range is 3, if the company has a, let's say, interest expense of $100 and a company is generating EBIT of $300, then we can say that the company is generating enough earning before interest and tax to cover up its expenses, and above 3 number could be seen as a good ballpark range. Now before moving on to step 5, which is the final step, I want to show one app that I use, which is Screener. .in, from where I usually see all these number and try to make investment decision whether the company is doing good or not. And based on what we see previously in this video, we will try to understand all the ratios and different things that need to be done or a kind of checklist thing to make an investment decision. So this is one company, NMDC Limited. This is not any investment advice. I picked this stock because it has everything covered. The first thing that we learned was our stock PE, which is price to earning. Here the PE ratio is 9.16, which means that we are paying company 9.16 for each unit of earning. Suppose a company is earning $1, then we are paying this company $9.16. And our next ratio was, let's say, current ratio. The current ratio of this company is 2.37, which means the company has 2.3 times more asset than its liability. We also look at book value. What is the book value of the company? Now this book value is divided by total number of outstanding share. So here the book value is 32.3. The next thing that we learned is debt to equity ratio. Here the debt to equity ratio is 0.15, which means if company has $100 of equity, there is $15 of debt. And the next thing we learned was quick ratio, which is here is 2.13, which is lower than our current ratio. Why? Because we remove the inventory part of it. As we know, current ratio includes inventory, but quick ratio does not. So our quick ratio will be lower than our current ratio. And remember, in the balance sheet step, we look at the third thing, which was cash flow statement. And here we can see that company has a positive cash flow, which is a good sign. And one more thing that we learned in the previous slide was interest coverage ratio. Here the company has interest coverage ratio of 69.5 times. And we also learned earning per share. Earning per share here is 7.37, which means the company is generating $7.37 per outstanding share. What else do we miss? Let me see. And these all are different kind of analysis you can look for, but basically I look for all the thing that I mentioned here as a key benchmark for my investment decisions. Now let's move on to step 5, which is comparing with competitors and industry benchmark. And our goal will be to compare our company against the industry standard or different company. What is the first thing that we look for is revenue growth and competitor. If our company is growing faster than our competitor or slower than our competitor, or in other way we can say that if our company has a positive revenue growth or negative revenue growth in comparison to our competitor, is the company growing faster or slower than our competitor? The same thing. What is the profit margin? Let's say our company X is having a profit margin of 15%, while on the other hand industry average says the profit margin within the industry is 10%, which means our company is delivering more profit within the same industry, which means the company has been operating efficiently, which is a good sign to start investing in the company. And that is what we are doing, compare operating and net profit margin. Now this does not stop at net profit margin. We can definitely compare different thing also, and these things could be valuation multiples also, which is price to equity, price to book ratio, and EV to EBITDA against industry peers. Price to earning we look at here is, let's say our stock PE is 9.16, but our industry average is 13, which means that average company on this industry we need to pay for $13 for each dollar of earning, but for this particular stock we are only paying 9.16, which means that we are getting our company at a cheaper price currently. So what did we learn? PE ratio lower is better. In common sense also, if you are trying to value anything or trying to price anything, the lower ratios gonna benefit you, because by lower we means that we are paying less for our company than the industry peers. And these were the five key steps, or you can say checklist, before investing in any company. You can make a checklist of all this thing in Excel file, and then from there you can pick a company which is 8 out of 10 or 9 out of 10 or 10 out of 10, fulfilling the checklist. So now we will move on to technical analysis. You must be thinking that why we are adding technical analysis when we are trying to analyze a stock and make a decision based on fundamental. But technical analysis also do matter, because not everything in the market is governed by fundamental. Sometimes the market are driven by sentiments also, which means that mood of investors, there are biases in the market, and not everything is efficiently allocated. So timing your investment becomes crucial also, because sometimes you, even if the company fundamentals are good, you don't want to invest in company when that company is not feeling good in the normal general public eye. So we will also look at few technical analysis so that you can time your investment. The very first one is our 52-week high and low, which is identifying key pricing level. Now 52-week high is the highest price a stock have reached in the past year, and 52-week low is the lowest price in the same period. These levels act as psychological barrier. Many traders watch them closely. As I said, market are definitely governed by biases also. Efficient market hypothesis does not always work. So we need to check for 52-week high and low. And how to use it? If a stock breaks above 52-week high, it is often signal strong bullish movement, because it has crossed its higher barrier, and we can say that people are watching this stock closely, and they are trying to make a bullish movement in that particular stock. And similarly, if the stock falls below its 52-week low, it may indicate further downside risk. For example, not any investment advice. If Reliance Industry hit 52-week high, trader may buy expecting further gain. Our next technical analysis is little bit technical, but it helps me as well for timing my investment, and it is 50-day and 200-day moving averages. Now what does this mean? Moving averages smooth out price fluctuation to identify trends. It helps in getting the momentum of the market, and it is kind of average out what is the price the stock has traded in the last 50 days. 50-day is our short term trend indicator, while 200-day is our long term trend indicator. Now how to use it? There are two type of cross that we will look for. The first one is our golden cross, which is when the 50-day EMA crosses above 200-day EMA, then we have a bullish signal. And the second one is our death cross, when 50-day moving averages crosses below 200-day moving average, then we have bearish signal. And we will gonna look at this with example of graph. And here is our graph. You can see that this particular line is our current stock price. This blue line is our 50-day moving average, and red line is our 200-day moving average. Here you can see that this particular 50-day average crossed here the 200 moving day average, building a golden cross when 50-day EMA crosses above 200-day. And we can see here that it is kind of getting crossed here, so creating a golden cross for ourselves. And the second one is our death cross, which is here. You can see that 50-day averages goes down below 200-day moving average, which kind of shows a bearish pattern. And you can see here also in the example how the stock have fallen, and how here on the golden gate, the stock price has delivered a good return. And our final technical analysis is looking for support and resistance levels. Now, support levels are a price level where a stock stops falling and bounces back, and resistance level is price level where a stop rising and reverse downward. You can use these indicator in any app, and then you can time those, and you can time your investment. And these were the key fundamental and technical analysis that we need to do before investing in any stock. So I do suggest you to make checklist of ratios and key performance indices, and do keep the checklist on your excel file. And if you're trying to analyze any stock, do fill the checklist if that particular company is getting 8 out of 10 or 9 out of 10 in those, and then you can make your investment decision in that particular company. By doing this, you will definitely gonna improve your long term portfolio by a good proportion, and you will be able to add valuable stock in your portfolio. I hope you enjoyed this video. Do give us like and subscribe to the channel, and press the bell icon for more finance updates.